So all of that is strong, unprecedented demand, really, really historically low inventory. Um, and part of the inventory that's missing also is distressed properties. So we're not getting existing homes, we're not getting new homes. The numbers we need, we're also not getting distressed properties. And that's would seem a little unusual because if you look at the mortgage delinquency rates, the serious delinquency rates, and those are loans that are 90 days or more past due, are at historically high levels. And this would normally be a big red flag and something I'd be very concerned about, because normally once you're 90, 120, 150 days delinquent on your loan, you're either in foreclosure or you're about to be in foreclosure. Kind of no questions asked. And that's not the case this time. We'll show that in a second. But there's a reason these numbers are as high as they are. And the reason, if the slide will advance for me, is that we're seeing a lot of these loans. Now it's going to jump ahead, of course. We're seeing a lot of these loans in forbearance. So the CARES Act forbearance program, excuse me, has done exactly what it's supposed to have done. It's giving homeowners in financial distress the opportunity to avoid really an unfortunate and probably unnecessary default. And there's a lot of confusion about this because a lot of people don't think the forbearance loans are actually in the delinquency numbers. They are. The individual borrower is not being tagged as delinquent for the credit bureaus and the credit reports, but the loans are being notated as not having a payment made in X number of months. And if you remember, the forbearance program was designed to give homeowners an initial 180 days of grace, with an option for another 180 days after that. Now, that's on government-backed loans, and that makes up about 2/3 of the loans in the market today. But most of the private loan portfolios agreed to kind of play along by the same rules. And so what we're really seeing is, if you really follow the numbers, what we've seen over the last couple of months is month-over-month declines in overall delinquencies and even in serious delinquencies. But the loans that are past 90 days delinquent are getting more and more delinquent. And the real bizarre thing for anybody who's been in this industry for a while is that, let's say you started with the program back in March in forbearance, you could be in that forbearance program for a full year. So you could be 360 days past due on your loan. And on day 361, you can agree to a repayment plan with your lender and you become immediately current. And we'll show you what's been going on so far in the program, but it's an anomaly. It's something that's never happened before. And so when people look at these numbers and expect them to behave like the numbers have always behaved, they're going to be completely out of whack. While we have seriously high delinquency rates, foreclosure activity is at an all-time low. So this is a chart from our parent company, Adam Data, and it shows foreclosure starts. And if you look at where foreclosure starts are today, they're actually at lower levels than they were way back before the last foreclosure crisis was even a thought or even on the horizon. So we're just not seeing any foreclosure activity at the moment because of the government's foreclosure moratoria. And if you're following that, you saw that FHFA, which runs Fannie Mae and Freddie Mac, extended their foreclosure moratorium through the end of January. The FHA recently extended theirs through the end of February. Candidly, I would be shocked if when the Biden administration takes over, these moratoria aren't extended at least through the end of the first quarter and possibly into the second quarter as well. So there is a foreclosure backlog building. When the pandemic began, there were about 250,000 properties in foreclosure. Those all froze in place. Those are part of the loans that are seriously delinquent that aren't in the forbearance program. So there's about 700,000 of those loans. About a third of those are loans that were already in foreclosure prior to the pandemic. When the moratoria expire, those loans will all come right back into the pipeline and probably be expedited. There are a number of loans that would normally be going into foreclosure for the reasons that loans always go into foreclosure, a kind of a loss of income, a divorce, a death, a medical expense that wasn't expected. And if you look at unemployment rates between pre-pandemic and where we are today, they've almost doubled. Now that's still lower than most economists predicted by the end of 2020, but we went from 3.5 to about 6.8, 6.9%. Would not be unreasonable, just to do some back of the envelope math, to suggest that maybe foreclosure rates also double if unemployment rates stay about the same as we go into 2021. All that said, that would get us back to normal levels of foreclosures. So for anybody who's expecting another tsunami, another repeat of what happened from 2008 to 2011, I just don't see that happening. In fact, what I do see happening is there's a record level of homeowner equity, about $6.5 trillion. According to our ATTOM data numbers, 70% of homeowners have more than 20% equity. So if you're a homeowner in financial distress and you have 20% equity in a market with extreme demand and limited supply, and you can't sell your home before foreclosure, you've done something terribly, terribly wrong. Yeah. And I suspect that is what's going to happen to the majority of properties where the owners are in financial distress. That they'll be sold prior to that foreclosure auction taking place, and most of the inventory that goes to auction will sell before it ever goes back to the banks. So for anybody who's looked at the distressed industry in prior cycles and waited for those REO properties, those bank repossessions, before they started looking to buy, I think this particular cycle is going to be very, very different. Majority of properties will sell while they're in the early stages of foreclosure, and most of the rest of them will sell at the auction. So if you're looking at those kind of properties, you need to be aiming a little earlier in the cycle. And just to get through a couple last slides on the forbearance program, you can see that as of the end of the year, about 5.5% of mortgages are in forbearance. There were some economists who had predicted that 25 to 30% of borrowers would be in forbearance. Thank God they were wrong. The program peaked at about 8%. So at about 5.5% of people in forbearance, we're looking at 2.7 to 2.8 million borrowers who are still in forbearance. By the way, about 20% of them have been in forbearance but have never missed a payment since the beginning of the program.
Wow.
And that's a very surprising number, but they either hedged their bets or just figured they could, do more with their $1,500 or $2,500 a month mortgage payment if they put it into savings and build up their cash reserves or pay down other debts or invested it in Real Wealth Network. So these are people that have just taken advantage of the program or hedged their bets, and you can see that the number of requests. And this is one of the reasons I feel the program is working the way it's supposed to. The number of requests peaked at the end of March. So the program was announced then. We had a huge spike in people asking to get into the program. And I would submit that if the situation were getting worse, we would have seen subsequent spikes at the end of April, end of May, end of June, end of July, end of August, when the next month's payments were coming due. And in fact, we've seen just the opposite. The last couple of weeks, we've seen a minor, and I really mean really minor, increase in the number of requests as we get close to the program's expiration date. So end of December is when getting into the forbearance program technically is over. Now that may be extended too, but at the moment it's the end of December. So the last couple of weeks, we've seen an increase of, maybe 0.1, 0.2%. But generally, this is flatlined. The other thing that's really, I believe, indicative of the fact the program's working the way it's supposed to is that, and these are obviously MBA numbers, 81% of forbearances are either on extension or have re-entered after exiting the program. And again, keep in mind, the program was supposed to be 180 days and another optional 180 days. So the bulk of people will be exiting by March. But the lenders, the servicers who offered the forbearance actually didn't go out and offer 180 days. They typically did this in 90-day periods. So you're in for your first 90 days, you asked for an extension. Now you're in your second 90 days. You got to the end of that, maybe you asked for another extension. Some of the people exited the program without having contacted their servicers to figure out what their options were, and we've seen them cycle back in as re-entrances to the program. But the fact that the majority of people that are in the program are either extended or re-entering tells me that the program is working because there's fewer and fewer new people coming into the mix. So again, it shows me less distress than you would expect during the course of a recessionary period. And this is probably my favorite chart of all, and probably one of the harder ones to read. But people have been exiting the program, and 87% have either simply continued paying their loan because they never stopped, have had their loan reinstated, have put together a deferred payment plan, which takes their missed payments and puts them at the end of their mortgage. They've entered into a loan modification, a loan repayment program of some sort. They've paid off their loans by either refinancing or selling the property. Only 13% have left without having one of those criteria in place. And as I mentioned, some of those are reaching back out to the servicers and re-entering the program. Now, this is since July through the beginning of December. So the numbers, the number of people exiting without a program in place have gone up a little bit in recent weeks, still in the 20% range. So you're doing an 80-20 rule. But this is what gives me the most hope that as we exit these government programs, we're not going to have the kind of carnage that you might have expected with 40 million people losing their jobs during this pandemic-driven recession. I think I pushed the button. I'm giving it a second. There we go. So closing thoughts. I believe the housing market surge is going to continue in 2021 because of demographics and mortgage rates. And then again, some of these home ownership trends the pandemic has caused to accelerate. I don't expect that we will see the kind of year-over-year price increases that we saw this year, because I do think we'll see more inventory come to market. But I don't expect to see a slowdown in buying activity, either in existing homes or new homes. Would not be surprised to see another increase somewhere in the neighborhood of 5% in terms of home buying next year. Foreclosure numbers are artificially low. They're going to remain artificially low until these government programs expire, whenever that is. And keep in mind, if the moratoria and forbearance programs all end at the end of March, everybody who's not already in foreclosure basically starts at that point. So you're probably 90 to 120 days from a lot of those borrowers being put into foreclosure, which takes you to the end of the second quarter, beginning of the third. And then when those properties actually wind up coming to market varies depending on what state you're in. In California, it could be a couple months. In New York, it could be a couple years. So it really just depends on where you are in the country in terms of when you'll start to see some of those distressed properties hit the market as foreclosures. It would be crazy for me to tell you we won't see default activity increase with all the job losses, but for all the reasons we've talked about, I think it's really unlikely we're going to see the kind of numbers we saw during the Great Recession. And keep in mind that we entered this pandemic running at about half as many foreclosures as we normally would have seen. So the market and the loan quality was extraordinarily strong. We didn't talk about this. We can certainly do it in the Q&A session. I believe the commercial market, if you're looking for different types of investments, is probably going to see more default activity than we'd normally see in a recession. And partly that's because of the nature of the recession and how it hit a handful of industries really, really hard. So if you're looking at retail opportunities, if you're looking at hotels, and it doesn't have to be the Ritz-Carlton, it can be a limited service hotel. I think you're going to see a lot of default or at least distressed sales in those markets. I think you'll see some short-term disruption in the multifamily and apartment market, although in the long run, demographics suggest a quick recovery and a lot of growth. And the office market will be really interesting to watch as more and more companies are letting their employees work from home. So you'll theoretically need less office space, but you also might need more office space per employee for the companies that are going back to the office because of health concerns. So that'll be interesting to watch in the long run. And then ultimately, what happens in the economy, what happens in the housing market is really going to be contingent on how well we do in getting this virus under control. So obviously, a Real Wealth Network is a great place to look for more and more of this kind of housing information. I would not be doing my job if I didn't tell you to take a look at Realty Track as well. I'm available too on Twitter and LinkedIn. Kathy and I are always commenting on each other's posts. So feel free to reach out and follow me there.